All right, welcome back to The Explainer. So, you've probably got the hang of buying and selling stocks, right? But now you're ready to level up, to go beyond just the basics and make some really smart investment moves. Well, you've come to the right place. Today, we're going to pull back the curtain and show you how the stock market is actually organized. You know that feeling, right? You look at the market, you see all the numbers flashing red and green, and it just feels like total chaos. One day it's soaring, the next it's plummeting. It seems completely random. But what if I told you there's a method to the madness? Okay, so let's dive right in. That whole jumble of flashing prices, it's not nearly as random as it looks. See, underneath all that noise, the market has a surprisingly logical structure. And if you understand that structure, that's the key to investing with way more confidence. And this structure, it really boils down to three main things. First, the size of the companies. Second, the indices that we use to track them. And third, the different types of investors, the people who are actually moving all the money around. If we can get a handle on these three concepts, we can finally start to understand risk, spot some real opportunities, and make sense of those wild day-to-day swings. All right, first up, company size. Probably the most fundamental way the market gets organized is by something called market capitalization, or market cap for short. I like to think of it like weight classes in boxing, right? You wouldn't throw a heavyweight fighter into the ring with a featherweight. And for a very similar reason, the market sorts companies into different categories based on their size. So, what is market cap? It's actually pretty simple. It's just the total value of all of a company's shares combined. The formula is easy. You just take the total number of shares out there and multiply it by the current price of one share. And boom, you get this one powerful number that tells you what the market thinks the entire company is worth at that very moment. Okay, let's look at a real-world example to make this super clear. Take a giant like TCS. They've got about, 37 crore shares floating around. So we take that number, we multiply it by the current share price. Let's say it's around 3,500 rupees. And you get this absolutely massive market cap of nearly 13 lakh crores. See? It's just simple math. Okay, but why do we even care about this number? What does it do for us? Well, here's the key. Company size is basically a shortcut for understanding risk. You've got your large caps, like TCS. These are the big, established giants. They're stable, they offer steady growth, but the risk is pretty low. Then you have the small caps. These are the up-and-comers. The growth potential can be huge, but they come with much higher risk and a lot more volatility. And mid-caps, they're, right in that sweet spot in the middle. Knowing this helps you pick investments that actually fit your own comfort level with risk. All right, so we've got companies sorted by size. Now let's go to the next level of organization, the indices. You've heard of them, the Nifty, the Sensex. Think of an index as a kind of barometer for the whole stock market. It's a tool that measures the overall health, the mood, and the direction of a massive group of stocks, all at once. Here in India, the two big ones you hear about constantly are the Nifty 50 and the Sensex. And honestly, they're pretty similar. The Nifty 50 tracks the 50 biggest companies on the National Stock Exchange, while the Sensex tracks the top 30 on the Bombay Stock Exchange. At their core, they're just baskets of the largest, most important companies, and we use them to get a quick snapshot of how the market is doing overall. But, and this is a really important but, here's where things get interesting. You'd think that with 50 stocks in the Nifty, each one gets an equal vote, right? 1/50th of the power. But no way, that's not how it works at all. There's this kind of hidden factor called index weightage, and it changes everything. And this is exactly what I mean. Look at a heavyweight stock like Reliance. Its market cap is so enormous that it makes up something like 10% of the entire Nifty 50. Think about that. It means a small 5% drop in Reliance's stock price can literally drag the whole index down with it. Meanwhile, one of the smaller companies in the Nifty could jump, say, 20%, and it would barely cause a ripple. This is exactly why you'll hear on the news that the market was dragged down by Reliance. It's all about that weight. Okay, so we've talked about company size, we've talked about market indices, so that brings us to the final and maybe most important piece of the puzzle: who is actually making all these moves? I like the ocean analogy for this. You've got millions of small fish swimming around. But then you have these few giant whales. And when they move, they create waves for everybody else. So let's break down who these players are. You've got retail investors, that's probably you and me, and you have high net worth individuals. But the real whales, the ones that make the big waves, are the institutions. On one hand, you have domestic institutions, or DIIs. Think of these as our local giants, Indian mutual funds, insurance companies, that sort of thing. And then you have the foreign institutional investors, or FIIs. These are the massive global funds that are moving billions and billions of dollars in and out of our market. If you want to see just how powerful these foreign whales are, just look at this number. This was from March 2020, right at the peak of the COVID panic. In that 1 month alone, foreign funds pulled out nearly 62,000 crore rupees from the Indian market. I mean, just let that sink in. An absolutely historic amount of money leaving all at once. And what happened when all that money vanished? This. The entire Nifty index plunged 23% in a single month. It's a perfect, almost brutal example of cause and effect. When that big foreign money decides to leave, the whole market feels the pain. And that is why the pros are obsessed with tracking this big money flow. It's a huge signal. When FIIs are selling like crazy, you know there's going to be downward pressure on the market. But when they're buying, that often feels a big rally. And our own domestic institutions, the DIIs, they often play a stabilizing role. They'll step in and buy when the FIIs are selling, which provides some much-needed support. Seriously, if you track the flow of FII and DII money each month, you can get some powerful clues about where the market might be headed 3 to 6 months down the line. Okay, so let's tie this all together. We've talked about company size, we've covered indices, and we've unmasked the big players moving the market. So what do you do with all this? Well, this knowledge is what helps you go from being a person who just kind of randomly buys stocks to someone who can build a real strategic portfolio. Think of this table as your personal blueprint. Now that you understand market cap and risk, you can actually build a portfolio that fits your specific goals. Are you a more conservative investor? Well, then you'll probably want to put most of your money, say 60–70%, in those stable large caps. Are you more aggressive, with a longer time horizon? Then you can afford to take on more risk with a bigger slice of your portfolio in mid and small caps. It's all about creating a mix that you're comfortable with. So there you have it. You now get the hidden architecture of the stock market. You see how it's organized by size, how it's measured by indices, and how it's moved by these giant pools of capital. You basically have the map. So the only question left is, where do you want to explore first? Which company in which category are you going to start analyzing?